$86 billion in 5 days. According to Goldman Sachs full data, that is how much systematic money just moved into stocks from CTAs alone, trend following algorithms that buy when prices rise and sell when prices fall. They do not think, they react. But that is only half the story. On top of that, we just saw one of the most aggressive call option buying sprees in recent history. And when dealers are short gamma, meaning they sold those calls, they are forced to buy the underlying stock to hedge. So the rally fed itself. CTA's buying triggered more buying, call options triggered more buying. And right now, the S&P 500 is at all-time highs. But the VIX, the fear index, is failing to make lower lows. Price says everything is fine, volatility says it is not. When I was trading size on the hedge fund desk, that divergence was the first signal that made us cut risk. So let me show you why I'm not adding to my long positions right now and what happened the last time machines bought this aggressively. This chart is global CTA positioning, the 5-day change in systematic equity buying worldwide. The mean is 0, the standard deviation is 28 and the current reading is plus 86. More than 3 standard deviations. That is an outlier. But here is the part nobody on financial media is telling you. Look at the circled days, November 2023, August 2024. Both had CTA spikes almost this large, and the market kept going up, so the bulls will say, see, CTA spiked before and nothing happened. But something did happen after September 2019. That spike was plus 80, almost identical to today. The S&P ground higher for a few more months, peaked in February 2020 and then fell 34% in 5 weeks. Now, correlation is not causation, and the 2020 crash had its own catalyst, but the positioning setup going into it was nearly identical to what I am seeing right now. So why did 2023 and 2024 survive, but 2019 did not? That is the question that changes everything, and the answer is one chart. This is the S&P 500 overlaid with the Fed's reverse repo facility. In 2023 and 2024, the reverse repo was draining from $2.5 trillion to nearly zero. That was trillions of dollars flooding back into the system, a hidden liquidity injection that cushioned everything. It absorbed the CTA unwind. It kept markets propped up. But today, the reverse repo is at 137 million, not billion. So cushion is gone. Bank reserves are below $2.9 trillion. The liquidity buffer that supported the last 2 rallies no longer exists. Months ago on this channel, I warned you that silver was set to fall and equities were vulnerable, pointing directly to oil as the breakout trade to watch. All 3 of those scenarios played out exactly as mapped. This is what we do here. We spot the rotation before the crowd does. If you want the next play before it hits mainstream news, make sure you subscribe. It gets worse. This is New York's Federal Reserve on repo operations data. In late 2019, banks ran out of overnight cash. The Fed had to inject over $250 billion in emergency lending. That was the first crack before the crash. Now look at early 2026. The same spike is emerging. The plumbing is showing stress and the stock market is ignoring it. Meanwhile, the total put-to-call ratio just hit 0.66. Historically, readings this low have coincided with periods of elevated complacency. And data from GMI sourced via Citadel Securities shows the institutional call-put direction ratio at plus 23%, the most aggressive reading in over a year. I'm looking at this and seeing crowded positioning. In my experience, crowded positioning tends to unwind quickly when narrative shifts. Now, after this, the Treasury General account, the government's checking account, is at $751 billion and swinging violently. Every time the Treasury builds this balance, it pulls cash directly out of the banking system, so if it rebuilds past $900 billion, the liquidity drain hits bank reserves that are already stretched. The Federal Reserve ended quantitative tightening in December and now is buying T-bills at $40 billion a month, but only T-bills, not bonds. That is de facto short-term Treasury refinancing, not stimulus. The question is whether $40 billion a month is enough when the TGA alone can drain hundreds of billions in weeks. The bull case is real. The Fed stopped shrinking its balance sheet, CTAs are providing massive momentum, the Iran de-escalation narrative is in a play, and S&P 500 just broke above 7,027 resistance. If you're a day trader, this breakout is tradable, but I'm a long-term investor. I view my capital as a strategic weapon, so I deploy it when the odds are heavily in my favor, not when the odds are noisy, and right now the odds are very noisy. Because according to LSEG data, the Strait of Hormuz is still functionally restricted. Tanker transits dropped from 18 a day to near zero. Reports indicate Iran fired on 3 ships on April 18th. If we project this trend and oil stays above $80 through May, that is planting season. So the diesel that plants your wheat, the gas that ships your meat, the entire food supply chain runs on energy. And right now, that energy flow is under significant pressure. At seasonality, midterm years since 1946 show clear weakness from late April through September. We are walking into the weakest window on the calendar. And the yield curve inverted for over 2 years has now steepened to plus 0.54%. Historically, major market drawdowns have tended not to occur during inversion itself, but during the steepening that follows. So we are right now in that steepening phase. However, if the Fed accelerates T-bill purchases and the TGI is penned down, this framework collapses, and if Hormuz genuinely reopens and oil drops below $70, the risk premium evaporates and this rally has room to run. 3 things to watch. The TGA, if it rebuilds past $900 billion, bank reserves get crushed. The VIX, if it reclaims 20 and holds, the divergence becomes a screaming signal. Oil, if it holds above $80 through May, the food supply chain comes under serious pressure. The last time I saw CTAs buy this aggressively without a liquidity cushion was September 2019. What followed was 34% drawdown. Past reserves do not predict future outcomes, but the setup rhymes. The breakout is real in price, but the buying was not driven by conviction, it was driven by algorithms. See you in the next one.